If Phoenix is no longer one of the more popular markets in the US, does that mean we are in trouble? Does that mean we are going to start to see decreasing demand, increasing supply, and prices going down? Possibly, because I have some data that says we are not the prettiest girl at the dance anymore. So we're going to get into that. We're also going to talk about the rental market, what's going on there, and some updates with inventory in the Phoenix area. So let's get into it. And by the way, you guys, you did not like my video last week about good news for the housing market. Apparently, we don't like good news. There was a lot of disagreements, a lot of negative comments last week. So sorry that it didn't align with what you were hoping to hear, but I'm just here to share what I'm seeing out there, okay? So this week we're talking about the most popular markets people are moving to, and hate to break it to you, but Phoenix does not make the list. We used to be on this list, and consistently, Arizona was somewhere in here. But now, in 2024, the most popular markets that people are moving to are actually in the South, the Northeast, and the Midwest. Phoenix is nowhere to be found. In fact, there isn't even anything on the West Coast anymore. Like, have we had our time? Possibly. And what is to come? I don't know. It'll be interesting to see. Columbus, Ohio, Knoxville, Tennessee, Jefferson County, Kentucky, Detroit, Pittsburgh, Portland, Tampa, Charleston. Love Charleston, by the way. Hartford, Asheville, North Carolina. I've considered moving to Charleston. I traveled there earlier this year. It was amazing. But now that I see they're on the most popular list, I don't know that I want to be going there and paying those home prices. So, but sad news, Phoenix is not on here. And like I said, nothing on the West Coast either. So it's kind of a changing tide right now, that these are the 10 most popular markets. So let's add to this a little bit more, shall we say, bad news for the Phoenix market. We just hit a new milestone here in Phoenix. We are one of the $1 trillion metros. So the U.S. housing market nears $50 trillion in value as the number of $1 trillion metros doubles. Phoenix just joined that list. So there used to be 4 metros in the U.S. that totaled over at least $1 trillion in home values. And now there are 8 total. We are one of the new 4 that have joined. So Anaheim, California, Washington, D.C., Chicago, and Phoenix all have joined the list of places where the total value of homes tops $1 trillion. Interesting that we've gotten here. The total value of U.S. homes gained $3.1 trillion over the past 12 months to reach a record of $49.6 trillion. This is according to a Redfin estimate of more than 95 million U.S. residential properties as of June of this year. It's interesting as we look down here to the particular metros. And they're talking about the ones with the fastest growing total home value. Phoenix does not make this list. They also talk about those with the slowest growing home value. Phoenix is also not on that list. But they do talk about the year over year increase in home values. And if we look at Phoenix here, it's $52 billion over the last year increase to get us to this $1 trillion aggregate home value. So I don't know if that's really good news. In particular, because we talk a lot about affordability and challenges with affordability. So knowing that our home values are reaching this, high and included in one of the 8 metros in the entire U.S. So that's not 8 is not a whole lot, right? We're certainly making news for, I don't know, maybe not the right reason. So this does not play in very well to the affordability factor in Phoenix. But I do have good news on affordability, and I will get there shortly. But let's talk about rentals. We haven't talked about rentals in a while, and there is an interesting article that came out talking about how the renter population is growing 3 times faster than its homeowner population amid rise in home buying costs. So this isn't a huge shock, right? We've talked, ad nauseum about affordability. And so people do opt to rent when renting is more affordable than buying. And in various areas of the country, you can achieve that. Some areas, it is more affordable to buy than rent. Phoenix has kind of flip-flopped. We, for a long time, were more affordable to buy than rent. Now rental rates are a little bit less than your mortgage rate because of where prices and mortgage rates are. And I'm going to break that down in just a second. But the number of renter households grew 1.9% in the second quarter, one of the biggest gains in recent years. Now, again, this is a national article. This is from Redfin, so they're not looking specifically at Phoenix, but just to give you an overall idea of what's going on out there with rentals. America's renter population is growing as the cost of home ownership climbs. Mortgage payments are up 90% from before the pandemic, and asking rents are up only 23%. So logically, this makes sense that we're going to see some growth in the rental population. The number of renter households grew at the second fastest pace since 2021, while the number of homeowner households grew at the slowest pace since 2019. So what is going to happen with rental rates as we see more demand for rentals? Are we going to see rental rates increase? It's possible if we don't have the inventory, but as I've mentioned in past videos, there is a huge boom in multifamily buildings. So perhaps that is going to be keeping up with this demand. They say the growth in the number of renter households hit a peak of 2.8% in the first quarter of 2024, and that's the largest gain since 2015. So we're definitely seeing a spike in that rental demand. The median apartment asking rent increased less than 1% year over year in June, while the median monthly mortgage payment jumped roughly 5%. Asking rents were 23% above pre-pandemic levels, and mortgage payments about 90% above. So we're in this situation nationally where rentals seem to be a better bet than home ownership as far as the monthly payment is concerned, right? Now, you can argue it one way or the other, but if you look at the long-term outcome of paying a mortgage, maybe you're paying more, but for a longer period of time, but you do own an asset that you can sell. Ideally, that's going to appreciate the longer that you hold that. Whereas with rentals, you don't have much to show for that. With rentals, however, you don't have a lot of those capital expenses that you'll pay along the way with owning a house. So, to each their own. There's arguments one way or the other. Of course, my opinion is that if you are owning a home, you are investing in an asset for the future, but I do not advise buying one to just sell in a year or 2 years or even 3 years. The goal of this is to hold it long term in order to actually have growth in that asset, right? So renting versus buying, the cost difference in 7 Arizona cities. I wanted to share this, and I will say I am cautiously sharing it just because I don't always know where they're pulling all of their data as far as like average rents and mortgages and whatnot. I like to get that information more from like the MLS or from the Cromford report. But regardless, just giving you an idea of what this like rent versus buy situation looks like in various cities here in Arizona. So in Phoenix, they are saying that the average monthly mortgage payment is $25.57, while rent is $17.39. So much more affordable to rent versus buy in the city of Phoenix. For Tucson, they're saying it is $19.83 for your mortgage payment. That sounds awesome compared to most of these Phoenix metro cities, and $15.40 for your average monthly rent. They go through a few different cities here in Phoenix Metro. So for Mesa, $26.92 for that mortgage payment and $17.08 for your monthly rent. For Chandler, average mortgage $31.63 and average rent $2,035. And by the way, you guys, this is good information to know if you're thinking about investing in a rental property to buy something, to see where that mortgage rate is versus where the rent is, the monthly rent, right? So it is challenging to cash flow if you're going to be getting a conventional loan for a rental property right now. If you're going to be paying cash or doing some other form of financing, you may be able to make the numbers work. In particular cities, it takes a little bit of analysis, but generally, right, we're seeing that the mortgage payment is higher than the rental rate. Mortgage in Gilbert, $34.61, average monthly rent, $2,200. Glendale, they have the mortgage payment at $24.82 with the rent at $17.39. And then Scottsdale, kind of the worst gap out of all of these, has the mortgage payment at $49.19, so almost $5,000 a month, while the average monthly rent is $21.35. And like I said, I share this cautiously because you can tell just from those numbers that that isn't like the best representation, right? Like there is a lot of luxury homes in Scottsdale, and the average monthly rent is not $2,135 for a home that is a few $1,000,000, right? There are a ton of like condos and small units that rent in Scottsdale, just the nature of like particularly in Old Town. So I think those numbers are a bit skewed, but overall, I would be willing to bet that your mortgage payment in Scottsdale is going to outweigh what you could rent for, more than likely, if you're looking into that. So let's look what's going on in Phoenix Metro from the Cromford report. And we haven't taken a look at this in a while. This is the median lease price by quarter. So it's not drilled down too much, but just to get an idea of the trend of where we're at, it's about $2,200 a month. This is for all of Phoenix Metro. You can see last quarter it was $2,195, so it's gone up just slightly. And then in Q1 of this year, it was $2,100 a month. Q4 of last year, it hadn't changed, but it was a little bit higher, around the same where we're at now last year at this time. So we'll have to follow this and see if this drops as we get into Q3 and Q4, or if this is going to stay elevated as we get into next year. But overall, the changes that we've seen in the median lease price by quarter has been somewhat cyclical lately, but has remained elevated from where we were at, in 2021. Obviously, we had big increases in rent, but not as big as we have seen in our mortgage payment. So let's talk about some good news for affordability. And you guessed it, it relates to mortgage rates. Homebuyers have gained nearly $30,000 in purchasing power over the last month thanks to the mortgage rate drop. This is according to Redfin News. They're saying that house hunters should consider jumping into the market now, with last week's soft jobs report sending mortgage rates to their lowest levels since April of 2023. Now, that is true. These rates have gone down to those very low levels that we haven't seen in 15 plus months, which is awesome. There's also that question out there of, are they going to drop further? Should I wait until I see a lower rate? And you always have that option, of course. The downside to that is rates don't drop any further. And this truly was your opportunity, right? It's really, really hard to know. What I will say from just a personal experience standpoint is I have spoken with 2 to 3 folks in the last month who have held off on home buying since wanting to start their home buying journey in 2020. And what they've seen is obviously drastic change in what they could have afforded then and what they can afford now. And now they're willing to jump in and bite the bullet, but they are kicking themselves for waiting for as long as they did, because the affordability factor is just so much different. Now, no one can promise that this is going to get worse than it is, or it's going to get better. It's really hard to know, which is why I always go back to, you have to do what's right for you personally, depending on your job status, your income, your financial situation, your time horizon, how long you plan to be living in this area, your long-term plan. Do you plan to maybe rent the house out in the future if you do move out of state or something like that? There's a lot to think about. Of course, there's a lot of economic factors as well, recessions, the election coming up, all of these things that people have questions about, but you really have to make the decision that's right for you. And then hopefully in 4 years, you're not kicking yourself that you didn't buy because home prices are even higher then. So take that as you will. But this is really cool because it is sharing the difference of how much of an impact mortgage rates are making on today's home prices. And whether or not you think it's the prices or the rates, or if prices need to come down and rates need to come down, whatever your opinion is, you cannot argue with the fact that if rates come down, the monthly payment is much more affordable. And so it can be very impactful when that changes. Homebuyer on a $3,000 monthly budget can afford $466,000 home with a 6.35% mortgage rate, roughly the daily average on August 5th. That buyer has gained nearly $30,000 in purchasing power over the last month alone. They could have purchased a $250,000 home with a 7.15% rate, which was roughly the daily average at the start of July. And the same buyers gained more than $40,000 in purchasing power since April, when mortgage rates hit that 5-month high of 7.5%. So basically, you can afford a house that's worth worth $466,000 now for the same price monthly as what you could have afforded a few months ago with a house that was $437,000 when the rates were higher. They also have this really cool graph that allows you to see the home price that you could afford for the different monthly payment amounts based on the mortgage interest rate. So this is assuming 20% down, a 30-year mortgage. They also assume 1.25% property tax rate, 0.5% homeowners insurance rate, and no HOA. So obviously this is not accurate, but it gives you a general sense of where you would need to be in terms of rate to be at a particular payment and what purchase price you could afford. They even compare what it looks like on a monthly basis. So to look at affordability another way, the monthly mortgage payment on a median priced U.S. home, which goes roughly $443,000, is $2,842 with today's average mortgage rate. And just a month ago, that payment would have been $3,032. So it'd be $200 more per month with the rates previously, as they were a little bit higher about a month ago. So just some food for thought to really put into perspective how rates are impacting your affordability, and these changes in rates that have happened over the last 4 to 6 weeks really are pretty powerful. And so if you are on the fence and thinking about it and hoping rates will go down, well, hopefully they do. If they don't, however, thinking back to what you would have been able to afford a month ago versus today, you're still in a much better place than you would have been at that point in time. And who knows how long that is going to stay where it is. If I have to guess, I'm going to say I think rates will stay around where they're at, and maybe we have some opportunity for them to continue to fall for the rest of the year. But I don't know for sure. So you really have to make that decision on your own. Why mortgage rates will probably keep falling before the Fed cuts rates. So we've talked about this on my channel quite a bit. Mortgage rates dropped to the lowest level in over a year. So we saw some big changes in mortgage rates last week and the week prior. And most of what had happened 2 weeks ago held steady through last week. But the point of this article is talking about how mortgage rates are not set by the federal funds rate. Mortgage rates are moving in anticipation of what the Fed says, how markets react. And so if you are waiting for the Fed to cut the rate in September, as everyone is anticipating, just know that is not what is going to affect mortgage rates. They're actually moving in anticipation of that. So any cut that the Fed makes in September, we're going to see that effect in rates before that September meeting. So that's essentially what they're talking about, that we may continue to see some more movement in rates as we get more data along the way and hear more from the Fed before that September meeting. This week, we're going to be getting the CPI inflation report. The CPI is going to be released on Wednesday. The anticipation is that the projection is that the headline CPI will come in at 0.24% for the month of July, and core CPI will be 0.27%. The PCE, so the Personal Consumption Expenditure Price Index, will be released on August 30th, and that is expected to show a similar pattern with 0.2% headline monthly inflation and 0.22% core inflation on current estimates. So as always, as long as these numbers come in as expected or beat these numbers in a positive way, showing that inflation is going down, that'll be good news for mortgage rates. So we'll keep an eye on what happens with the CPI report as that comes out later this week. And if you're out there as a home buyer, just know you may want to check in with your lender in case there's any big news with mortgage rates that would impact the rate that you're able to get. And by the way, as we're talking about mortgage payments and affordability and all of these numbers, if you're curious what price you need to be within to hit a particular mortgage rate and kind of mess with those numbers, check the description below because I have a link where you can use my mortgage calculator to get that information. Now let's get into what's going on in the Phoenix metro area. And of course, as always, if you are new here, consider subscribing. We are here every single Tuesday, and share this with someone who might find value. So this CMI this week week. This is the Cromford Market Index, different than the CPI. I follow the Cromford report. They pull all of this data from the MLS, and they are so amazing with everything that they're able to analyze and provide to their subscribers. And so any number on this CMI, this index between 90 to 110 is considered a balanced market, and we're at 99.7, so right in balance. Really hasn't changed since last week. The only thing that we've seen really change has been the supply index actually went down a little bit. I think it was 74.1 last week, so negligible, but it did change. So we saw a little bit of a decrease in supply, and demand has remained around the same level. So as I've said, for week after week, we've got supply and demand basically at the same number, meaning that we are in a balanced market across all of the Phoenix metro area. Now, every city behaves a little bit differently, and so we're checking this out to see what's going on in each major city throughout Phoenix. If you'll notice, you have Fountain Hills at the very top. This is actually in a seller's market. Remember, anything over 110. So they're pretty far up there into that seller's market. And so I would consider that being, a fairly strong or certain seller's market, but nothing that's like what we saw years ago, where those numbers were in like the 200s and 300s. We've got Chandler still in a seller's market, although it month over month has gone down by 14% on the CMI. Avondale, Scottsdale, Phoenix, Mesa, Glendale, Gilbert, all in sellers markets. Then balanced markets, we have Paradise Valley, Peoria, Tempe, and then Cave Creek is also in there. Goodyear, Surprise, Queen Creek, Maricopa, and Buckeye, all in buyers markets. You can see the percent change month over month for each city. We've had some that have moved more significantly than others, like Tempe moved in the direction of a buyer's market over the last month by 20%. Cave Creek moved in the direction of a seller's market by 14%. So each city kind of varies in the direction that they're going, and all of that is dependent on the supply in the area and the demand, how quickly homes are going under contract, how many homes are on the market. It is an algorithm that they've created, and I don't know all of the details, but I do know that this has always been proven to really show us kind of the direction of the market and what we can anticipate as we go along. The overall change for these cities on average month over month was actually negative 1.8%, which is way smaller than last week, which we saw negative 4.4%. And the weeks before that, I think it was negative 5, negative 6. So we've been slowing down in terms of our acceleration towards a weaker market, which is evident in the fact that that CMI number hasn't really changed much week over week. We've just been kind of hanging around at this like 99, 100 range for quite a while. So although we were seeing some momentum downward for a bit, it seems like that is beginning to slow down. So as we look at our contract ratio, this is another way to measure the heat in the market, and it's by zip code. This doesn't look all that different from last week. We still have a lot of green, which is that warm, balanced market. We've got a few areas that are hotter than others, a few different zip codes here, kind of in those same areas. So overall, we're seeing a lot of balance, a lot of warm, and then a few areas that are hotter than others. We haven't looked at inventory too much lately, so I'm going to pull up our inventory graph here so we can see where we're at. And we've been pretty steady. So we climbed at the beginning of the year, which is different than our normal inventory basically pattern that we typically see. And you can see all the years here for the last 4 or 5 years. Usually we start to see a drop in inventory in the beginning of the year because we have a lot of activity from buyers and a lot of that inventory gets soaked up. This year, what we saw was a climb in inventory, but it's held pretty steady. We haven't continued to see that increase in inventory since that kind of leveled off. I want to say it was around the April-May timeframe. We've been pretty stable here. We're at about 16,000 active listings as of this week. You can see in the past, that pattern of kind of dipping as we begin the year. This was 2022, so that was a little bit of an anomaly there. But where we're at today is remaining pretty steady. I would anticipate that as the year continues, we'll probably see this start to trail off a little bit. I don't think we're going to see a big increase in inventory, but keep in mind as you're hearing news articles talking about inventory being up a certain percentage year over year, they are comparing to last year and prior years where we had very low inventory. And the path that our inventory is on this year is not a concerning path. We're not seeing huge spikes. We're just seeing elevated from previous years and kind of holding steady. Now, why this is important to you as a seller is because you want to know what kind of competition you have in your area, right? If inventory is high, you're in more of a buyer's market. Buyers have choices, and therefore you may need to compete with other sellers by bringing your price down in order to get your home sold. So it's important to know what's going on with inventory in your area. If you are curious about that per zip code, I can pull this information by zip code. So just check the description below and click for more information. I can get you the amount of inventory in your zip code. All right, you guys, that's all I have for this week. I will see you next Tuesday on another market update.